individual how much equity do you have, they won't even know because a lot of it gets automatically invested in all these compulsory plans. I think we need to get to that situation at some point in time. UK, it's again 72% investment in equities. It's a very large number. Surprisingly, Germany is very low at around 11%. Japan again is about 24%, and India is at about 5%. So, I mean, that shows, how underinvested we are as a group in equities. Let me take a quick example in terms of, what's happening with, equity investments in India. Let's say, for example, we have an individual who's got about 10 lakh savings, right? And he walks up to you, and typically your advice would be, okay, you're young, you're 30 years old, invest 50% in equity, 50% in debt, and this is a solution for you. But in reality, let's assume that this individual is making about 10 lakh rupees per annum every year, right? And typically he would do that, and I'm not taking any inflation or just rough, if he's going to earn 10 lakh rupees every year for the next 20, 30 years, that's like a bond investment, right? With an annuity, right? You have to look at it that way. Now, if you reverse calculate the present value of that bond investment, you'll get about 90 lakhs or so. If that number, if that investment, if that earnings of 10 lakhs continues for the next 20, 25 years. You add that back to the 10 lakhs he already has, and look at the magic. He's got 1 crore actually today, but he's invested only 5 lakhs out of that in equities. So what does this tell us? That people forget the future potential earnings and then look at the current net worth of the individual, which could be at the lowest, because as the guy ages, his earnings potential is going to multiply. So it's very important for us to realize that equity investments has to be made considering these aspects also. Equities investment without emotions. I mean, this is something which we need to sort of, say to ourselves every morning, I guess. Investors tend to follow a hot asset class, whichever is working, people want to chase that. And that's precisely the reason why people haven't made money. In India, even around the globe. I have an example there. And the reason for that is different asset classes actually follow different cycles. When I say that, for example, it was fashionable to invest in gold maybe 3-4 years ago. It was fashionable to invest in bonds 2-3 years ago. Equities is now fashionable. So the tendency is to catch that next hot asset class. When do we know when is the right time, right? It's usually, it's after the fact, right? Once the asset class has become hot, that's when you, tend to increase your investment exposure. In reality, one has to do that, on a contrarian basis. Now, here's an example of US. This is a typical US investor return over the past 20 years. The blue block is actually how much he has made on an annualized basis, 4.3%. Look at what the S&P has done, double of that, the right side, 8 point something. A typical bond investor has done even worse. He's got 1% compared to 6. So this is not unique to India. This is actually world over, because that human emotional quotient which plays on our mind day in and day out, does not enable us to take a very pragmatic and a practical view and say that no matter what, this is going to be my asset allocation. I'll make changes according to, valuations, etc. And over the long term, I'll make, I have this target, this is where I want to be. Okay, a simple example of, India, for example, last 35 years of data, right? Equity markets have actually gone up a lot. We have done about 16-17% annualized return. I don't need to preach you that equities is the best asset class today. The fact of the matter is, there were 4 or 5 incidents where equity markets gave returns, negative returns of excess of 20%. Unfortunately, we remember only that. We have forgotten that equity markets have given significant amount of returns over a period of time. So what is the answer here? The answer is very simple. Stay invested, no matter what. In the quest for identifying the next 20% downfall, we tend to miss the next 5 years of a bull market. This is the real dilemma of local investors. Okay, so the real question is it equity and debt, right? And the big problem is, for us, is it equity or debt? The answer is not that. It's actually equity and debt, which over a period of time is going to give you, a reasonable return, which will help you in your retirement in terms of creating wealth over a period of time. The risk of having only equities, for example, as an asset class in your investment universe is that it's extremely volatile. So it's very natural to assume when the world collapses, if you have 100% equity, you're going to obviously come in and sell. Similarly, debt returns, if you sit only in debt, it's going to barely beat inflation or not even that. So for example, in 2007, if you had, say, 50-60% in equities and 40% in debt, the chances are that you wouldn't have touched your 60%. You wouldn't have sold. On the other hand, if you had 100% equity, you would have sold in panic and at the worst possible time. That's the point I'm trying to drive. So solution. Asset allocation is the solution to all of this because asset classes can be volatile. Asset allocation reduces volatility and risk over a period of time and generates superior returns. Helps investors to stay with a long-term perspective and remove emotions out of investments. And average stock and bond investors have underperformed their quest for chasing superior returns. Here's a snapshot of how different asset classes move. I think it's a little difficult to see, but you can see the volatility. I mean, the reason for putting this chart is that, every asset class has its life cycle. Every asset class tops and bottoms at different points in time. The question is, how do you, if you're going to switch from one asset class to the other, how are you going to figure out, which is a hot asset class, which is the asset class that you want to be? There's no answer to that. Okay. Sorry. There's no, okay. Okay, typically an investment decision is based on, four decisions, which asset class, what is the normal policy weights of that particular asset class, and the allowable ranges, right? 85 to 95% of overall investment return is due to the first two decisions. Rest are all immaterial. And this is from data. This is from hard data. When you actually look at the overall situation, I think time horizon, goal investing, these are concepts which we all know, but unfortunately don't follow. So it's very important to identify the investor's age profile, etc., the risk tolerance, the outlook of the investor, and then come up with a solution. So, what does a typical asset allocation model do for you? I mean, typically, many of the simplistic ones just look at the individual attributes, right? The age, risk profile, etc., and then give a proper asset allocation. In our view, what we have internally realized is that along with the individual risk profile that we normally do, it's very important to superimpose a valuation model, which will actually tell you what is the right asset allocation based on the valuations of different asset classes. So we have actually constructed a model between equity and debt based on certain valuation parameters, which gives us the right equity as debt allocation at any given point in time. We backtested this particular model over 15 years, since 2000, and then found that although the absolute return, the first column on the left side, the absolute return may be identical. And we are comparing this to a pure equity benchmark. Okay? The absolute return is marginally higher. The orange block is marginally higher over a 1, 3, 5 years. Look at the risk-adjusted return. You have actually, and the standard deviation for that is actually given at the lower portion. 1 year, the standard deviation is, really less. And if you, as you go further, 5 years, the standard deviation is actually low significantly. And look at the risk-adjusted return. It significantly outperformed a typical equity class. This is the number you should be looking at, because this is a number, the risk-adjusted return is actually telling you what? That at a low risk, at a relatively low risk, you're giving almost the same return. And that will prevent you from panicking at the bottom and getting euphoric at the top, which are the two big dilemmas that we have with investors. Let me stop here and see if there are any questions.
Now, how do you prevent IFAs and advisors to take decisions which are not to do with, so how do you prevent them from panicking at the bottom and getting exuberant when the markets touch it?
Right.
Any this thing that you would suggest to this audience here, how can they prevent this?
Sure. I think it's a very pertinent question, because what we want to give investors is a steady return over a period of time. We are not talking about the highest return. We are talking about steady return over a period of time, right? The only way, as I said, is to have a matrix, have a very rock-solid risk profiling mechanism in terms of the current earnings, your current wealth, and the future earnings, and then come up with a proper balanced asset allocation solution for our investors. We have, we have started working on this model-based, kind of solutions. We've got some excellent backtesting results. So over a period of time, as 15 years, 20 years, 30 years, you would notice that the risk-adjusted return of some of these, solutions. I'm sure there are a lot of other solutions too, but the key thing is to stick to the discipline and not follow the trend, not follow the hot asset class, as I was saying.
So, do you plan to convert your model into a tool which they can use?
Well, we are working on it, and hopefully, if we sort of get encouraging results out of it, and we'll definitely do something of that sort. Yes, but the answer is yes, because we are developing something internally to do something like that.
That I think would be very useful.
Yeah.
Now, there's an interesting question here. Are you suggesting that IFAs should do asset allocation, or should we go after asset allocation funds which are less tax efficient?
Yeah, interesting question there, because if that particular fund typically follows a particular discipline and it has got an established track record, then I think definitely. But at the same time, if one believes, because that's one formula which will not suit for everyone, right? Each individual has got a different risk profile, different outlook, etc., etc. So in effect, you are actually mapping the entire thing and suggesting tailor-made solutions to different individuals. I think, while asset allocation funds are doing a great job, there's no question about it, but, it may not suit everyone's requirement.
Okay. Now, which asset allocation would you prefer, a strategic or a tactical one?
We typically like the tactical one, because strategic, let me just explain the difference between strategic and tactical in two minutes. Strategic normally, keeps a fixed weight across all time periods, 50, 50, 60, 40, whatever. Tactical actually, which is where the model actually comes in, tells you effectively that one asset class has become overvalued, so you need to sort of reduce it. And these are long-term tactical. When I say tactical, it doesn't move very abruptly, over a quarter or over a year. It's a very steady kind of adjustment to your asset allocation over a long-term period, so that, you are never hurt whenever there is a bubble. And each asset class, take it from me, over the last 20, 25 years that I've seen markets, every asset class goes through this bull phase and bear phase. There's a bubble, and there is a phase where things are absolutely at the low. So my suggestion would be to go for tactical allocation, whereby you look at the valuations of different asset classes and invest accordingly.
Another interesting question, if you're a long-term investor, is there any need for doing any asset allocation?
Yeah, provided if you're long-term and you stick to that discipline, definitely not, because equities as an asset class will give you the best return over time. Unfortunately, human minds, get influenced by global developments. It gets influenced by movements in equity markets, etc. But if you're willing to stick to the investment, your discipline and stick to equity investments, history has suggested that equities has given at least 16, 17% annualized return. Sorry. Probably not. I mean, in 10, 15 years, you complete a couple of cycles and then you still end up being a winner. And at the same time, your capability of picking the right kind of stocks, see, that's the next level of it, is also a big question. If you stick to good quality companies with great fundamentals and stick to it when times are bad. See, good companies also go through bad cycles, right? You have to stick to that through all of that. You cannot say that, oh, I'm going to change this because... So if you have a disciplined approach and if you understand what you're doing in terms of picking your stocks and staying committed to it for a long period of time, absolutely.
Okay. That is a terrific presentation.
Thank you.
Thank you, Ravi, for those interesting insights. Moving on, I'm now happy to introduce Gaurav Mashruwala. Gaurav has done much more than all of us put together to educate millions of Indian households to arrange and organize finances. Life cycle planning goes much beyond financial planning. And who better than Gaurav to take us through the nuances of life cycle planning? Gaurav, please.
How do I change? Okay. So, life planning or life cycle planning, I mean, two different connotations. So, when you're looking at life planning is what I'm going to touch upon more, but life cycle planning will entail certain part of it within it. So, when we are looking at life planning or life cycle planning, we are going beyond financial planning. We are looking at things which is much larger in our life than just numbers. Invariably what happens is, and that's what I'm going to speak more, what happens in financial planning. Now, let's look at a situation when we talk about financial planning, and I'll spend about 1 or 2 minutes talking what happens in financial planning and then move to life planning. Invariably, when it comes to financial planning, most of the time the focus is on a single aspect of finance, which is assets. Right? Now, if we look at it, it's finance itself is a much, much larger gambit than just assets. So if I was to ask a question to the audience, how many of y'all want a large amount of wealth? Just put your hands up, people who want large amount of wealth. Please put your hands up. Everyone? Brilliant. Now look at us. Now I'm going to ask you one more question. How many of y'all have put a number to it? This is the number that I want. It could be in lakhs, it could be in crores, it could be whatever. How many of y'all have that exact number written down on a sheet of paper and you keep looking at it? So, you know what? And this is what is always happening. 5% of hands went up when I said how many of y'all have put number. See what we are doing in life. We want a lot of wealth. We want to be multi-millionaire, billionaire. And we want to achieve that number but that number has not been articulated. So aren't we chasing an illusion? And if we are chasing an illusion, if we are chasing a number which is illusionary number, will we be ever satisfied? What are we chasing? Well, there's something which is not defined. Now, it could be different for different set of people, but that's what keeps happening. And then we are looking at financial planning. Now, see what happens in financial planning. Actually, financial planning consists of 4 wheels of finance: income, expense, assets, and liabilities. These are 4 wheels. Now, unless all 4 wheels are moving in a synchronized manner, will your car move? Imagine if you were to focus only on the front left wheel of a car and try and rotate there. Will car move? If you're trying to say that, no, I think that's a wrong wheel. Let me just focus on the front right wheel. Will your car move? It sounds weird, right? Absolutely weird. And yet, we just keep focusing on only one wheel, which is assets. Invariably, all of us financial advisors, may we call advisors, IFAs, distributors, whatever, we just keep talking about assets. Ye investment karna hai. Which is a good stock, which is a good script, what is asset allocation, and I'm not against this. What kind of asset allocation? We are not looking at the entire gambit of finance in a comprehensive manner. And unless you don't look at it in a comprehensive manner, you're not doing financial planning. And I'm still at financial planning. I've not even moved to life planning, because life planning stays beyond that. But unless the financial planning itself is not understood, in media, when we do that, and I mean, I keep doing shows and I write, the emails that comes, the questions that comes, when we do chat session, which mutual fund is good? I want to invest money for 10 years. What should be the asset class? We are not looking at beyond. Now, if you are not looking at beyond one particular aspect of money, which is assets, we are not going to enjoy the financial freedom that we want. So that itself is very narrowing. Now, when we look at life planning, it goes beyond this, because a lot of us feel, including me, that if we have enough money, we'll be happy. Now, if that's the case, then at least put that number which I asked in the beginning, that at this number I'll be happy, but that number is also not defined. So it's time actually to introspect what are we doing in life. When we look at life planning, and where is the definition of life planning? To be honest, it's in our scriptures. All scriptures talk about life planning, because that's where the true definition of wealth is. And we just kind of ignore. Can somebody tell me what is the most important wealth of our life? Perfect. So that's one wealth which we speak about. So, you know, health is wealth, and Gujarati ma pehlu sukh to jate na rahe. I mean, all religion, all sect, all languages, first is health. The second wealth that's spoken about is our social wealth. So we are looking at our family, our friends, our relatives. So that's the second wealth. Third wealth that we are talking about is our emotional wealth. And that's where we are seeing more and more people into depression, into stress, hypertension. So that's the third wealth. And the fourth wealth is financial wealth. Now, unless all 4 wheels of your life are not moving in synchronized manner, you will not enjoy any one of them. You know, actually it's pretty interesting that it's not just one. So when I was talking about financial planning, I said that it's not only assets that can take care of your entire life. You have to look at income, expense, assets and liabilities simultaneously. But when we are looking at life, we are saying you have to look at your financial wealth, your physical wealth, your social wealth and emotional wealth. And only when those 4 are moving in a synchronized manner is when you'll be able to enjoy any one of them. Otherwise, you won't be able to enjoy any one of them. Let's look at a situation where somebody has 50 crores portfolio. Is that a good amount of money? Yes, no. Yes, 50 crores is good amount. 50 crores portfolio sitting in a hospital bed where you require a ward boy for your routine requirement. Is that a good situation? How many of you are willing to swap that? 50 करोड़ दिया, अस्पताल में सो जाए, वार्ड बॉय की जरूरत है, नर्सिंग की जरूरत है. 50 करोड़ is not a small amount. How many of you all want that? No? Why? Is money the most important? And I'm not against money. Believe me, I'm never saying don't look at money. Honestly. Because we need money for our food, clothing, shelter, healthcare, education. Unless you are a hermit. And if you're a hermit, you wouldn't be sitting here. Neither would I be here. There's Himalaya. If you can't afford, go to Narmada. There are different places where you can go. You wouldn't be sitting in a Cafe Mutual event in Lalit and saying, I'm a hermit. So money is important. In fact, again, if you go back to scripture, there are certain brilliant things they have stated. They have stated that good people should accumulate wealth and use it for the benefit of mankind. If they don't do it, it's the bad people, not so good people will acquire it and will use it for the destruction of the entire universe. So there is no way I'm saying wealth or financial wealth is not good. But if your physical health or a physical wealth is not strong enough to enjoy that wealth, whether you have 50 crores or 1 crore, does it really matter? I had another case, and just very recently, I'm talking about an instance which just happened last week, where a lady came to my office, and a young lady, she's about